Do not trust here. So Warren Buffett has, he's gotten out of, some S&P 500 items, right? And in this video, I'm going to break it down and why he might have done that. So hit that subscribe button, hit the like button before I break it down. Let's go. So Warren Buffett's Berkshire Hathaway has recently sold 100% of its holdings in the S&P 500's ETF, SPY and VOO. This move has reported in Berkshire's latest, 13F filing, which discloses the company's equity holdings. So the sale of these ETF positions is notable for several reasons. You have the scale, the divestment amounted to over $44 billion. You have the timing. The sale occurred during a period of market strength, with the S&P 500 reaching new highs. You have the rarity. Buffett has long been an advocate for index investing, making this move somewhat unexpected. However, it's important to contextualize this decision. Now, you have the portfolio impact. These ETF holdings represented a very small portion, approximately 0.01% of Berkshire's overall portfolio. You have cash position. The sale aligns with Buffett's recent strategy of increasing Berkshire's cash reserves. You have the market outlook. Some speculate this could signal Buffett's concerns about potential market volatility or economic challenges in 2025. So Warren Buffett's Berkshire Hathaway has made several notable investments recently, again, according to the company's latest 13F filing for the fourth quarter of 2024. You have the Constellation Brands, right, STZ. Berkshire initiated a new $1.2 billion position in this alcoholic beverage company. Domino's Pizza, DPZ, right? Buffett increased Berkshire's stake in this pizza chain, adding over 1.1 million shares. You have the Pool Corp, POOL. Berkshire boosted its position in this swimming pool supplies distributor by nearly 50%. You have the Occidental Petroleum. So the stake in this oil and gas producer was increased by about 3.5%. You have the VeriSign. Berkshire's position in this domain name registry company was increased by 3.6%. SiriusXM, the stake in this satellite radio company, was increased by about 12%. So while SPY and VOO track the S&P 500 index, there are some notable differences that might have influenced Warren Buffett's decision. So you have the expense ratio. VOO has a lower expense ratio, 0.03%, compared to the SPY, 0.09%. So this difference, although small, can compound over time and result in higher returns for VOO investors. Liquidity is next. SPY has significantly higher trading volume, approximately 38.3 billion average daily volume compared to VOO, approximately 2.33 billion. So this higher liquidity could be advantageous for large institutional investors like Berkshire Hathaway. Now, in regards to performance, due to the lower expense ratio, VOO has slightly outperformed SPY in recent years. For example, in 2019, VOO outperformed SPY by 0.13%. The dividend yield, VOO tends to have a slightly higher dividend yield, which is 1.36%, compared to SPY at 1.22% due to its lower expense ratio. You have the fund structure. SPY is structured as a unit investment trust, while VOO is structured as an open-ended fund. The difference, right, or this difference can affect how dividends are handled and reinvested. You have Warren Buffett's stance towards, the S&P 500 in 2025 is basically mixed, right? While he has historically been a strong advocate for S&P 500 index funds, recent developments, like what he's doing now, suggest he's taking a more cautious approach. So Buffett has a long recommended S&P 500 index funds for most investors, citing his belief in America's long-term economic strength. So he consistently argued that these funds outperform most actively managed funds due to lower fees and broader market exposure. However, Berkshire Hathaway's performance has been closely matching the S&P 500 in recent years, with only slight differences in returns over various time periods. So this suggests that even Buffett is finding it challenging to significantly outperform the market. So Berkshire Hathaway's cash position has grown substantially, reaching $325 billion at the end of 2024's third quarter. This large cash holding could indicate a more cautious outlook on the market. There are unverified claims that Buffett has sold all S&P 500 holdings and increased cash reserves, potentially warning of a stock market crash or recession. Now, what I'm telling you should be treated with caution, as it, there's not really official confirmation, wink, wink, right? So based on, recent developments and trends, Warren Buffett's upcoming letter to Berkshire Hathaway shareholders is likely to address the company's significant cash position. Like the record cash levels, Berkshire's cash pile has, again, $325 billion at the end of 2024's third quarter. This amount represents about 28% of Berkshire's total asset value, the highest level since at least 1990. Then you have the continued growth. The cash position has continued to increase, with reports suggesting it may have grown even further in the fourth quarter of 2024. Now, the reasons for the cash accumulation: so Buffett and his team have been selling stocks, including significant reductions in long-held positions like Apple and Bank of America. They've cited difficulty finding attractively priced investments in the current market environment. So the high interest rate environment allows Berkshire to earn a decent yield on its cash holdings. That's what I have for you today. Hit that subscribe button and the like button if you gained value and you got what you came here for. If you got what you came here for, hit that subscribe button and the like button. Also, let me know your opinion in the comment section below. See you in the next video.